Hello everyone. I want you to picture your accountant's face every April. You max out your 401k again, you did the responsible thing, and you still wrote a six-figure check to the IRS. If that sounds familiar, I need you to hear this. Maxing out a 401k is not a retirement strategy for a dental practice owner. It's the floor. Most dentists think it's the ceiling, and that's the gap between the floor and the actual ceiling is worth $100,000 a year or more. And very rare someone will tell you about this. My name is Natalia. I'm certified tax coach and certified tax planner, and I run custom accounting CPA. We work specifically with dental practice owners, practices doing between $1 and $5 million in revenue, who are paying more in taxes than they should be. And this is episode 3 of our 12-part series, and today we are talking about 100K retirement deduction most dentists completely ignoring. Here is the reality. Your financial advisor set up your 401k years ago, back when your practice was smaller. It was the right move at that time, but your practice grew, your net income grew, and nobody came back and told you the plan should grow with it. So you're still finding a plan for a $300,000 practice while you're making, let's say, $600,000 or $800,000, sometimes more. You are not under savings because you're careless, but you are under sheltering because the plan on file was never redesigned for the income you have today. You didn't get into dentistry to become a retirement plan actuary, and honestly, you shouldn't have to. Most of the retirement advice floating around out there was built for a W-2 employee making $150K a year, not a practice owner who could legally be sheltering 3 or 4 times of that amount. It's a gap in the advice you have been given. For 2026, a solo 401k lets you defer up to $24,500 as employee, $32,500 if you are 50 or older, and up to $35,750 if you are between 60 and 63 under the new super catch-up rules. And the employer profit sharing piece as an S corporation owner, and the total combined limit reaches $72,000 if you are under 50 or $80,000 at 50 plus years old. That's real money. But if your practice nets $600,000, you are still paying full income tax on somewhere around $520,000 to $530,000. A standard 401k was never built to shelter income at that level. It was built for a $100,000 a year employee, not a practice owner. A cash balance plan is a type of defined benefit plan completely separate from your 401k that lets a high-income practice owner shelter dramatically more. The contribution room isn't a fixed number the way a 401k is. It's actuarially calculated based on your age and a target retirement benefit, which is why the closer you are to retirement, the more you are allowed to put in each year. There is simply less time left to fund it. For a dentist in their mid to late 50s, for example, annual cash balance contributions commonly land somewhere in the $150,000 to $250,000 plus range and can run higher depending on compensation history and plan design. Let me put real numbers on this. So you are, let's say, 56 years old, your practice nets $500,000 a year, and you're already maxing your solo 401k at $80,000. Right now, you are paying tax on roughly $420,000 of that income. Your actuary runs the calculation and finds that you qualify for $180,000 cash balance contribution this year on top of your 401k. That drops your taxable income to $240,000 at a combined federal and state rate of 40%, let's say. Those $180,000 cash balance contribution alone will keep you $72,000 out of the IRS hands this year. And that money doesn't disappear. It goes into a retirement plan that you own. Here's a piece most dentists have never heard of. A cash balance plan can be designed to include a whole life insurance policy as part of how it's funded. IRS allows this under what's called the incident benefit rule. Generally, up to half of the plan's contribution can go toward whole life premiums, as long as the death benefit stays proportional to your projected retirement benefit. If structured correctly, you still get the full cash balance growth you would get anyway. However, on top of that, your family gets an income tax-free death benefit if something happens to you before retirement. And because whole life builds cash value, that policy can also become a source of supplemental income for 15 to 20 years on top of your cash balance payout. This has to be designed by your actuary and an insurance specialist together so it passes the IRS. It's not automatic and it's not for every plan, but it's worth asking about. Also, here is what rarely being talked about. A cash balance plan requires a third-party administrator and an actuary. I personally don't calculate these numbers myself, and neither should a generalist CPA. This is specialized work, and it should be. The IRS also expects these plans to be permanent, which in practice means funding them consistently for at least 3 to 5 years, not just in a high income year and then walking away. And if you have a staff and a spouse, then you will typically owe them a minimum contribution too, often in the range of 5 to 7.5% of their pay, depending on how the plan is designed. So none of this make this a bad strategy, but it make a strategy that has to be modeled correctly before you sign anything. Again, if you have employees beyond yourself and your spouse, you will need to contribute to your employees in the range between 5 to 7.5%. Very important. Now, here is what I want you to do with this information. This is one where the exact number matters more than the concept. And that number has to come from an actuary, not from me on Facebook Live. If you want to find out what you would actually qualify for, message me the word retirement and I will connect you with the actuarial team we work with, and they will run a preliminary illustration based on your age and your practice numbers. So before you spend $1 setting anything up, you will know exactly what it can do for you. And this assessment has no cost attached to it. So it's for free. Next week, we are talking about your car, your boat, your second home, the business use rules that the IRS does allow, and the ones that people abuse and then regret. If today gave you one thing to think about, one moment where you thought I should look into this, then it was worth 10 minutes of your time. Share this video, tag a colleague, and I will see you next time. Same time, right here. Again, I'm Natalia with Custom Accounting CPA, and remember, you deserve to keep more of what you earn.